Hey there, it's Phil here. There's a lot going on in the world and also in markets, so I just wanted to sit down, film a quick recording so that we could talk about what's happening and how to think about it. I'm filming this on Wednesday after market close, but yesterday on January 20th, which was a Tuesday, we saw the S&P 500 experience its largest single day decline since October of 2025. In addition to that, there was a bit of bond market volatility as well, where we saw a bit of a sell-off in US Treasuries. To illustrate that volatility, we have a few charts. On the left, I want you to pay attention to the purple line. That is the S&P 500 and its return on January 20th and January 21st. Notice that the return went as low as negative 2.2% on January 20th. As for the Treasury yields, we have a number of different maturities here, followed by the yields as of January 16th, the 20th, and the 21st. We also calculate the day-to-day change of these yields. I want you to pay attention to the maturities going 7 years and beyond. Notice how here Treasury yields increased by a larger amount. You might be wondering, if Treasury yields rise, isn't that a good thing? The reality of it is, when bond yields go up, bond prices go down. There is that inverse relationship. Therefore, that's why we mention bond yields experience a bit of a sell-off. What drove volatility in both these markets was really two main catalysts. Number one was the Trump administration's proposal to buy Greenland in conjunction with the sudden tariff threats on 8 NATO nations, ranging between 10 to 25%. The second catalyst is going to be surging interest rates on Japanese government debt. This happened because Prime Minister Sanae Takaichi came out and called for a snap election, basically trying to rally more support and political authority for her fiscal stimulus measures. Japan already has the largest debt to GDP ratio amongst developed nations, so the fact that you're talking about increased deficit spending as well as a ballooning debt problem, that had investors concerned, which is why they demanded a higher yield on Japanese government bonds. That demand for a higher premium eventually leaked into the US Treasury markets, which is why we also saw an increase in yields here. That's the play-by-play of what's transpired over the past few days, but we now turn our attention to where do we go from here? To answer that question, I think we really need to contextualize what's in front of us without overreacting. So let's first contextualize the tariff situation. We've seen this dance before. Last year, we had Liberation Day, where the Trump administration came out and basically said, you get a tariff, you get a tariff, and you get a tariff, right? It was essentially a big ordeal where markets eventually sold off pretty significantly. However, after that, you had a little bit of a dialing back of the rhetoric where you had some language softening, you had tariffs being delayed in some cases. All in all, we ended 2025 up double digits in equity markets. Now, I'm not saying we're going to get a similar level of a drawdown as we did Liberation Day, nor am I saying it's all sunshine and rainbows and the worth of tariff policy uncertainty is behind us. However, I am acknowledging that this is a pattern where the Trump administration likes to escalate and then de-escalate using tariff policy to get what it wants. At the same time, markets will react and then reprice accordingly based on what we've seen. This happened just today, where after President Trump dialed back some of the rhetoric on Greenland and the tariffs on European nations, you saw the S&P 500 respond pretty favorably. In addition to that, you had US Treasury yields actually retreat. When bond yields go down, bond prices go up. We still have to recognize, though, that tariff policy does bring uncertainty and thus risk with it, right? But that risk is very hard to quantify. How do you know which member nations are going to get tariffs and if they're going to be in a position where they can cause the US pain and thus engage in a tit for tat? Or how do you know if markets are just going to be like, this is a nothing burger, on with our day? It's very difficult to tell, but that's ultimately why, based on the pattern we just described, as well as the uncertainties that come with tariff policy, we believe we shouldn't make portfolio decisions and over-index on tariff turmoil. The second thing we'd like to talk about is US Treasuries. We've had some clients come to us concerned about US Treasury debt, and I think concerns range from central bank independence and that impact on treasuries, or inflation, or even things like the global economy using less and less treasuries in perhaps years to come. I believe those are all valid concerns and risks, but we also have to acknowledge that the degree and timing of those risks can be obscured by headlines and the noise that the media makes. Sometimes the media will make it seem like this is going to be a overnight big regime change. But the reality of it is these are, if they fall into place, going to be very slow, gradual shifts. Given that context, we should take a step back and understand the reality of the US Treasury and where it stands against its counterparts. Right now, the US dollar and US Treasury still account for approximately 56% of global foreign exchange reserves. In addition, it accounts for approximately 90% and is involved in 90% of foreign exchange transactions. That is far beyond any of the other currency counterparts here, whether it's the euro, the yen, etc. Right? And it doesn't even come close today. So in many ways, the US dollar with US Treasuries is still the world's cleanest dirty shirt. That's our perspective for not focusing on the short-term Treasury volatility. We might get more of that, but we have to understand the broader context of where the US Treasury still sits. It's still a safe haven asset, and it's still the most liquid security market that we have. Therefore, I would encourage to not overreact based on short-term Treasury volatility or short-term Treasury noise. Talking about focusing on the short term as well as focusing on the big picture, I'd actually like to take a step back and look at the longer term, right? And I want to start by looking at drawdowns over a longer time horizon. Here in front of us is a bar chart that gives us S&P 500 data going all the way back to 1989 on a yearly basis. The salmon color represents the maximum drawdown that the S&P 500 incurred in any of these given years. And then the navy blue bars represent the return for that year. And what you'll notice here is that there are indeed a lot of salmon color bars across the board. And that really goes to show us that drawdowns are a normal part of equity investing. Volatility is a normal part of equity investing. But more surprising to me here is, despite there being somewhat notable drawdown numbers, and a drawdown you can think about it as the most decline that the S&P 500 experienced in that given year, despite there being pretty hefty numbers here, in a lot of these cases, the calendar year returns was still higher for the S&P 500, or still high, or still positive. So despite the drawdowns, you still ended up in a better place than where you started the year, right? And that just goes to show how investors who stayed the course were rewarded. Here's another slide that we'd like to borrow from our end. This is called 97 Reasons Why People Did Not Investing. Year after year, there could be a myriad of reasons someone comes up with as to why they don't want to buy the market. Back in 1939, you could say it was World War II having begun. In 2021, you'd be concerned about meme stock, bubbleness, and being worried about that. But the reality of it is, even if markets did experience drawdowns after these years, if you had invested 10 grand at the start of this period, you would have ended the period with $3.9 million. Again, those who stayed the course and remained invested were rewarded rather than trying to overthink market entry and exit, right? That market timing aspect that's so difficult to execute. That's going to be the long-term perspective, but our final recommendation is to stick to your operating procedure. When we build the asset allocation and portfolio constructs for our clients, we're already considering a few things in the operating procedure. Number one, we're making sure that portfolios are adequately diversified, mitigating against concentration risks, whether it's concentrating in a particular name or names versus concentrating into an entire region, right? And avoiding things like home country bias. We want to make sure that the asset allocations constructs are aligned with your risk tolerance. It should be aligned with your ability to take risk, which is going to be your financial goals over the long term or your upcoming liquidity needs, and also your near-term innate responses to volatility, right? Your asset allocation constructs should reflect how you react to volatile times. Rebalance into weakness is our final recommendation here, which is don't be scared to lean into the pain and let go of the joy if there is a bit of a market pullback. Right, deploying capital into market weakness will only be conducive for longer-term capital appreciation. So again, there you have it. Stick to your operating procedure. That is our recommendation for navigating potential volatility in 2026. But otherwise, I hope this was helpful. Let me know if you have any questions, and let's talk again soon.